Well, good morning, everyone. Welcome to the next series in the Working in Australia webinar series. And today's session will be covering payroll tax and medical centres. My name's James Trainer and I'm a partner in BDO's tax practice in Sydney. And I welcome all of you to the session today, which is a really topical session. And it's a really interesting collision in some respects between federal health policy that is trying to deliver health services to a wider range of people in a most efficient model as possible, and state revenue, which is focused on collecting taxation, and in this case, particularly payroll tax, on what it deems to be wages. And it's an interesting dynamic between the federal and the state governments, which is playing out, and we'll certainly hear more of that from the esteemed presenters who are with you today. Now, in order of presentation, firstly, I'd like to welcome and acknowledge Stephen Schoninger, who's a partner and head of employment and workplace at Avant Law. And we're delighted to have Stephen and Avant co-present with us on this really important topic. We'll also have here from Stefanie Merlino, and she's a partner in BDO's Melbourne office, focusing on people advisory and employment taxes, and obviously payroll tax being a key part of that. And we'll also hear from Leisa Rafter, who's a partner specialising in indirect taxes in BDO's Brisbane office. Now, before we get into the nitty-gritty, let me just cover a few housekeeping points for you. So you can, if you're having any difficulties, just listen through audio rather than catching the recording of the presentation. Of course, the video will be available afterwards, so you can see our wonderful faces. Everyone is automatically muted, but if you do want to ask a question, then we would love to hear from you, and you can do that through the questions pane, and that'll be submitted to us. And if we have time, as the presentation goes forward, I will look to answer those questions at the end of the session. If you have any technical difficulties, there's a link there where you can get some support. And following the end of this session, we'll also send you out a follow-up email, which will cover a few things, including a link to the recording of the session, just in case you missed anything or had to drop off during today's webinar. It'll give you some access to future and past webinars as part of the Working in Australia series, and also some contact details in case you have any further questions and like to follow up. So the agenda that we'll go through today is covering sort of 3 points. Stephen will first talk about a case outline and cover the two key cases, which is really driving the changes in payroll tax that we're seeing impacting quite significantly the health services industry. Stefanie will then take us on a bit of an overview of payroll tax, and it's just kind of going back to cover some of the basic points, because a lot of practices haven't had to face payroll tax before, so this is something new to them. So we'll very briefly cover just a high-level overview of what payroll tax entails. And then finally, Leisa will get into some recent rulings that are specific to the cases that have come out, and also the amnesty, and talk about those across the various states. And finally, if time permits, we'll look to have a panel session at the end just to cover a few questions and tease out a few topics and issues that we've noticed in our practice as we've been going forward. So without further ado, let me hand over to Stephen to talk about the case.
Thanks so much, James. Hi, everybody. Thanks so much for joining us today. I'd like to start off everything today by giving you, as James said, a quick overview of the key decisions that have really opened up the payroll tax issue for medical practices over the last 18 months or so, and look at some of the lessons we can take from those cases from the perspective of looking at what we can do as medical centres to set ourselves up to seek to limit exposure to potential liability on doctors' earnings moving forward. So I suppose a future-facing view in relation to establishing ourselves. Optical Superstore, this first case, is the leading Victorian authority in the area, and it's really the case that started it all for the industry a while ago now. So the Commissioner of State Revenue for Victoria issued a payroll tax assessment to Optical Superstore in respect of its optometrists' earnings, on the basis that the contracts between Optical Superstore and its optometrists were deemed to be a relevant contract that met the test for payroll tax. There were multiple appeals. Ultimately, the case went all the way to the Victorian Court of Appeal, and the Court of Appeal upheld the Commissioner's payroll tax assessment for Optical Superstore. So in this case, the key facts that I want to draw out that went to the contracts between the practice and the optometrist being relevant contracts were that in that case, Optical Superstore had entered into what it called tenancy agreements with its optometrists, with a rent, so to speak, that payable by those optometrists based on the time the optometrists provided their services to the store. The optometrists were required to provide optometry services to customers of Optical Superstore, as opposed to customers or patients of the optometrist, very key point, and were required to provide their services at agreed times and locations. They were found to have in fact, actually, in accordance with that contract, provided services to Optical Superstores as well as to customers or patients. The fees generated by optometrists for their work were collected by Optical Superstore into a trust account. They were held on trust by Optical Superstore for the benefit of the optometrist, but that didn't matter because the Payroll Tax Act operates on a flow of money, which is one of the key factors that we'll see is relevant in these key cases and in others that have arisen. So because of those reasons, the Supreme Court of Victoria upheld the Commissioner's assessment for payroll tax against Optical Superstore, and it was held liable for payroll tax assessments in the amount of $269,000 and change, which included penalties and interest for the period from 2005 to 2011. So that's Optical Superstores. If we go to the next slide, please, James. The next key case is the Thomas and Nas case, and this is the leading New South Wales decision, and it directly concerned a medical centre operated by Thomas and Nas Proprietary Limited. Very similarly, the case took the same sort of process that Optical Superstores did in Victoria, where there were multiple appeals. We went to the New South Wales Court of Appeal, and it similarly upheld the Commissioner of State Revenue for New South Wales's payroll tax assessment against Thomas and Nas, the practice owners, on the basis that the relevant contracts between Thomas and Nas, the practice, and the doctors working at the practice were deemed to be relevant contracts for payroll tax purposes. The facts in Thomas and Nas that made those agreements relevant contracts were terms providing for the provision of services by doctors to patients of the medical centre, so exactly the same position that we saw in Optical Superstores. And it was ultimately found that the doctors were providing services to the medical centre and to patients, so there was sort of the dual category there. The doctors were required to provide their services to the medical centre 5 days a week, and they were also required to give advance notice and seek approval if they wanted to take any leave. The doctors had a contractual obligation to promote the best interests of the practice, and this included not channeling patients away from the medical centre. So a very standard, I suppose, non-solicitation or non-competition restraint that many employees would potentially have. The doctors needed to abide by the medical centre's operating protocols, and the agreements also imposed non-competition restraints on the doctors after the agreements ended. So in all of the circumstances, those were facts that pointed towards the contracts being relevant contracts attracting payroll tax. And so the Court of Appeal upheld the New South Wales Commissioner's assessment, which in this case totaled $795,000 and change, including penalties and interest against Thomas and Nas, and that was for the period from 2013 to 2018. The interesting little aside in the Thomas and, oh, sorry, James, yep, thank you. Just for 1 second, one final interesting point here is that one of the Justices of Appeal in the New South Wales Court of Appeal made an observation that there were other doctors working in the Thomas and Nas Medical Centre who received payments directly from patients into the doctor's own business bank account, and they were not included in the State Revenue Commissioner's payroll tax assessment against the practice. So there were these two different groups of doctors in the practice. Now that was just noted as an observation by one particular judge, and critically that judge did not consider third-party payment provisions that Stefanie will touch on that can be relevant for payroll tax purposes. But it's a telling and interesting observation that, you know, as to some of the clues that we can take and the lessons we can take from these cases in looking at the relevant legislative tests. Thanks, James. Next slide, please. So what do we take away from these leading cases and other relevant cases that we've seen in the area? Firstly, we can't undo what has been done, and the reality is that your medical centre may have payroll tax liability if your agreements with doctors are falling into the category of a relevant contract, and other relevant payroll tax exemptions that Stefanie will touch on do not apply to you. But looking forwards and taking a forward-looking view, if we're to draw a line in the sand and look at things that a medical centre can do to establish itself to seek to limit its exposure to potential payroll tax liability in respect of doctors' incomes, we can take away a few things. Fundamentally, we have to look at the nature of the business that we are operating as a medical centre versus the nature of the business that the independent doctors are running. Properly characterised, doctors are running their own independent businesses, providing healthcare to their own patients. And the medical centre is in the business of providing services and facilities to doctors and is not itself in the business of providing healthcare to the community. That's a really fundamental point against which all of the other, I suppose, lessons and takeaways we can see from these leading cases turns. All of the medical revenue does seem to be essentially needing to be received by the doctor directly. So that would include patient fees, Medicare contributions, any third-party payments for the medical services the doctor has provided to his or her patients must be paid directly to the doctor. Where that isn't possible, so for example, if we think about teaching payments, where you have independent doctors at your practice who are fellowed and who are providing supervision for employed registrars, it may not be possible to have that arrangement in place. And so in those circumstances, you really need to be looking at a separate agreement with the doctor specifically in relation to those very limited services to facilitate payments for those services. It's very important to also look holistically at your arrangements. There is no magic contractual fix to all of this. It's a very holistic view that is required. And so we need to be reviewing our websites and our broader marketing collateral, our new patient forms, our privacy disclosure forms, and making sure that all of our ducks are in a row, so to speak, to ensure that the way that the practice is operating is consistent with the contractual arrangements that need to be in place to be underpinning this, I suppose, true service agreement model that from the cases appears to fall outside of that relevant contract test. So with all of this, it's really critical to be reviewing your service and facilities agreements that are underpinning the way that you're working. Next slide, please, James. So in relation to those agreements, I think please get your agreements professionally reviewed. It's important to always get your agreement between the practice and the doctor in writing and signed. The agreement should expressly state the fundamental nature of each party's business and the relationship between them. So it needs to expressly state, as I said, that the doctor is in the business of providing healthcare to their patients and the medical centre does not provide healthcare to any patients. It provides services and facilities to doctors only. Again, we want the contract to be reflecting that the revenue should be paid directly to the doctor. To this end, the doctors should be setting their own patient fees, not the medical centre. Avoid things like sign-on bonuses and other incentive payments from the practice to the doctor. They're very common, especially with new doctors who are trying to get their feet under the desk, so to speak. A practical alternative may be to offer an initial discount on the services fee that you charge doctors for a limited period of time to help them get their feet on the ground. We want to avoid rostering or specifying working hours or leave restrictions or anything or any other administrative controls over the doctor. Again, the doctors are running their own independent businesses, and so these are all matters properly for the doctor to determine as to how they are going to run their business. It is not a matter for the centre to be imposing on the doctor. Patients and patient records similarly should belong to the doctor because the patients are the doctor's patients. Those records are the doctor's records of the healthcare that they have provided. But we can put in place licensing arrangements for practical purposes so that the centre can retain those records in a practical sense. We certainly need to be avoiding non-competition restraints and restraints on the solicitation of patients. That is fundamentally because, again, the patient relationship is the doctor's relationship. The relationship, the medical centre is not in the business of providing healthcare to patients. The medical centre is in the business of providing services and facilities to doctors. So on that basis, we have no legitimate interest in requiring non-solicitation of patient restraints or non-competition restraints. I appreciate that a lot of these things are quite a leap in the thinking that we have generally applied as medical centres historically. I've put a couple of questions at the bottom there on the slide that you can see around indemnities and, do you want to also retain a right to vary the service fee? I've seen a number of practices seeking to put indemnities in their service agreements so that the doctor is providing an indemnity for the benefit of the practice for any payroll tax assessment that might be levied against the practice arising from that doctor's earnings. I think that I don't personally love this. It is happening. I think that the enforceability of those sort of provisions is ultimately questionable from a public policy perspective. I know that doctors are quite understandably resisting the inclusion of those sorts of clauses in contracts, and I certainly would not be relying on just putting an indemnity for the payroll tax in my contracts as the solution if we're not prepared to go back to fundamental basics in terms of looking at the way the business is operating. It is, though, possible to reserve a right in the contract to vary the service fee, and this is quite common so that you can account for increased costs of doing business, whatever they might be, including potential payroll tax liability. That is not going to be a short-term solution if you do get hit with a substantial notice of assessment, but it is a mechanism that you might be able to practically utilise to make adjustments to the service fee the doctor is paying your medical centre for increased costs of doing business. At this point, I'll hand over to Stefanie to continue the discussion.
Thank you, Stephen, and good morning, everyone. That was a really interesting session. I think that some really great takeaways. Cannot undo what has been done, I think, is a really important takeaway. It highlights the importance of reviewing historic, what you've been doing, what your agreements look like, and also making sure you get that legal advice and those agreements drafted properly. So changing the scene a little bit, and as James alluded to earlier, what has become apparent from our conversations with a lot of medical practices is that a lot of practices haven't had a need to pay payroll tax due to wages being below certain thresholds, so don't actually have a complete understanding of how the regime operates. That's why I'm setting the scene a little bit for the next few minutes and basically providing an overview of how the regime works before Leisa will then go into the details and the specifics of the revenue ruling and the amnesty arrangements. So to begin with, payroll tax is a state-based regime. So each jurisdiction has their own legislation. Some jurisdictions have identical legislation, and there are some unique differences in other jurisdictions. It is largely harmonised. A number of years ago, the various states and territories entered into a harmonisation protocol with the intention of simplifying the regime. But that doesn't mean there are not differences, and as I continue my discussion, you will see some of those differences highlighted. If you have to pay payroll tax, it's a monthly obligation. So you need to lodge a monthly return that is due by the 7th day of the following month. There are some unique rules in some jurisdictions. Typically, you have a monthly return that must be lodged for July to May, and that basically serves as an instalment towards your year-end payroll tax liability. In June, you're typically preparing your annual reconciliation, disclosing your annual taxable wages. and that's typically due for lodgement by either the 21st or the 28th of July, depending on jurisdiction. Payroll tax applies to taxable wages, and it applies where you exceed the applicable threshold. So there's two aspects there that we'll explore further, and that is what is taxable wages and then what is the threshold. So if we move on to the next slide, you will see that I've got a table here which really highlights the misalignment across the various jurisdictions. There's differing thresholds. Victoria has the lowest threshold. It's currently $700,000, although that is set to increase to $900,000 next year, and goes up to $1.5 million where it sits in South Australia and Northern Territory. So where you operate, let's make things simple. If you operate in one jurisdiction and you are a standalone entity, you will only have a payroll tax obligation where your taxable wages exceed the applicable threshold. Where they exceed the threshold, you will pay payroll tax at the rate set out on the slide, so their current rates. Now, things do get more complicated, and that's I'll cover off on that shortly. For example, where you've got application of grouping provisions, you need to look at those thresholds across a group. And I've got an example which will hopefully clarify how that all works. So if we move on to the next slide, the next aspect I wanted to explore is what is taxable wages. So taxable wages, it's basically your payments going through payroll, as you can see on the first few dot points. Superannuation goes into your taxable wages calculation, directors' fees, grossed up fringe benefits, shares and options, and the very topical one for the purposes of today's webinar, contractor payments. The payroll tax legislation contains what are known as relevant contract provisions, which is where we end up with payroll tax applying to certain contractor payments. Now, WA is the exception to the rule. In Western Australia, the legislation does not contain relevant contract provisions, which means those practices operating in WA are probably very grateful that their legislation operates that way. They don't need to worry about this particular issue, because the way things operate in WA, unless you're engaging with an employee at common law, you will not have payroll tax obligations. However, that is not the case in any other jurisdiction because of the relevant contract provisions. So a relevant contract exists where there is a supply of services in relation to the performance of work by one party for or on behalf of the other party. So that's what a relevant contract is per the legislation, excluding where an exemption applies. Now, the legislation contains a number of exemptions. There are 6 general exemptions, noting there are some exceptions in some states. Not all states have all of those. And there are 3 specific exemptions I've set out on the slide, but they're really not relevant for the healthcare sector. In terms of general exemptions, so you'll see there are 3 that I've boldened. They're the ones that we would typically expect may be available depending on how you engage with your GPs and allied health professionals. And Leisa will be talking to those in a bit more detail shortly. But essentially, it's where you engage for 90 days or less during the financial year, where you're engaging labour. So it's 2 or more people providing services under the one contract, and where a contractor ordinarily renders services to the public generally. And that example might be where you've got a GP or a health practitioner who is servicing or working for multiple clinics and providing the same types of services. Now, in terms of our next slide, payroll tax grouping. So I alluded to at the beginning of my discussion the fact that grouping provisions will have an impact where you're looking at that threshold and whether you have to pay payroll tax in the first place. So the legislation in each jurisdiction contain provisions that will group 2 or more entities, and what that means, payroll tax obligations will arise where the total group wages exceed that applicable threshold. So some of the factors that can create grouping obligations are where there's a related bodies corporate, where there are common employees working across 2 or more businesses, where there's a controlling interest, so more than 50% is considered a controlling interest, and where tracing provisions apply. And the tracing provisions operate such that where the total direct, indirect, and or aggregate interest exceeds 50%, then those entities will be grouped. So if we move on to the next slide, I've got an example there just to help put that into context. Medical practice A operates in Victoria and has a total of 7 employees. Total taxable wages of $620,000 were paid during the 2024 financial year. And there are 2 directors that each have a 50% interest in that practice. Medical practice B also operates in Victoria and has a total of 3 employees. We've got the same 2 directors who have a 50% interest in medical practice B, and those total taxable wages of $430,000 were paid during the financial year ended 30 June 2024. So in that example, we've got application of the common control provisions, which will group medical practice A and medical practice B. So when you look in isolation at the taxable wages for each of those practices, you would expect that they would fall below the threshold. But unfortunately, the impact of grouping is you need to total up those total group wages and then assess whether that threshold is exceeded. And in this case, total group wages are just over $1 million, which means there will be an obligation for both practices to register for payroll tax purposes, and a payroll tax liability will apply on the amount exceeding the threshold in Victoria, which is $350,000. So I think that's a really important thing to know about the grouping provisions, because they can absolutely apply where you've got the situations that trigger grouping provisions, and it will then mean you may be in a situation where you have to consider payroll tax and register for payroll tax, where ordinarily in isolation you may not have to. So something to be aware of. Now from here, Leisa's going to cover off on the very important revenue ruling and the amnesty arrangements. So thank you, Leisa.
Excellent, thanks, Stephanie. So now we're just, now we're just going to go through some of the rulings that have been issued by the various revenue officers, and also the amnesties that have been announced by certain revenue officers. And what you'll see is these rulings came as a result of the Thomas and Naz decision and the appeal decision. So a lot of what Stephen's talked about in terms of his practical comments and what taxpayers should do going forward, you're going to see those themes coming out in the rulings. So some of the points that I'm going to touch on might be repeating some of what Stephen said, but that's just because they're really important factors that are going to be considered by the Revenue Office. And obviously, the legal drafting of the agreements is extremely important, but also what's actually happening in practice and the reality of payment flows and what's on websites and marketing material, is also most likely going to be taken into the account in the event of an investigation. So where we'll start is there were a number of revenue rulings issued. And as Stefanie mentioned, we do have a harmonised payroll tax regime, largely, except for WA, but a lot of these provisions in terms of relevant contracts and how they would apply in the medical centre space are largely harmonised. So what we've seen happen, and I've just outlined on the table here, is we've seen a number of rulings being issued by Queensland, New South Wales, Victoria, South Australia and the ACT. So the initial issue of all of these rulings, the rulings were very harmonised. Some of them were almost identical. Queensland did update its ruling on the 19th of September. And so Queensland has a few extra facets specified in its ruling that haven't been commented on by the other revenue officers at this point. And the most important thing that you may have seen is that payments directly to a medical practitioner, either from Medicare or the patient, so that's funds going from Medicare to the practitioner's account, or from patients directly to the practitioner's account, the Queensland Commissioner has confirmed that those will not be deemed taxable wages for payroll tax purposes in Queensland. And we'll talk about that a little bit later. Also, we've seen a couple of jurisdictions issue amnesty arrangements. And you can see that in Queensland, South Australia and the ACT, there are positive obligations to actually register for the amnesty. These jurisdictions have been quite clear in their documents that if you do not register by the due date, you will not be covered by the amnesty. So there's not an option to opt in later. But interestingly, what we've seen is we're seeing the amnesty dates be extended. So in Queensland, the amnesty date has been extended multiple times, and that's the date for which you lodge your expression of interest. Also in South Australia, they had an amnesty deadline of the 30th of September, and that's recently been extended to the 30th of November. So my main takeaway is that if you are a GP practice and you are operating in one of these jurisdictions, you should really consider whether the amnesty would be beneficial for you, and definitely take some advice or give it due consideration before you let any of these dates pass by. And sorry, I should have said the amnesty is only relevant to general practitioners. It's not relevant to any kind of allied health or specialist medical practitioners. If we move to the next slide. So essentially, I'll go through just the highlights of the harmonised ruling, and they do recap on what we've discussed. So the rulings do outline a very broad application of the contractor provisions under the various payroll tax acts. They also confirm that a contract between an entity that conducts a medical centre and a practitioner will be a relevant contract where certain criteria apply. So payments under relevant contracts, as Stefanie discussed, would be taxable wages and subject to payroll tax. So there will be a relevant contract in place where all of the following apply. And I've just outlined those on the slide, but essentially where a practitioner carries on a business of providing medical related services to patients. And in the course of that business, the medical centre holds out to the public that it provides access to medical services. It engages the practitioner to supply those medical services by servicing patients on its behalf. And importantly here, that can be express or implied. And so it will be implied where the medical centre has operational and administrative control. And I'm going to go through that shortly on the next slide, but that will encapsulate some of those comments that Stephen has also made that would be relevant to the drafting of the services and facilities agreements. And so where those factors are present, there will be a relevant contractor unless one of the contractor exemptions applies. So when we're looking at operational or administrative control, each of the rulings have actually expressly outlined a number of factors that if they're present, then there's more likely to be operational and administrative control on behalf of the medical centre. And so these types of things are where the medical centre prescribes the hours of work of the practitioner. So the number of days that they might have to work or attend at the practice. Also, if the practitioner is directed to see patients from a physical location or space or within the medical centre, which I know is quite common, but it's a prescribed factor within the rulings. Also, if the practitioner has to sign up to patient fee and payment and billing protocols of the medical centre, so that might be in relation to signing up for bulk billing arrangements or certain out-of-pocket and fee arrangements. Also, the existence of restrictive covenants on the practitioner. So those might include things like exclusivity during the arrangement, and also any kind of restraint that's drafted into the agreement that might outline where the practitioner can and can't practice following the end of the agreement. Another important thing to note is that it doesn't matter whether the medical centre holds payments either beneficially or as agent to the practitioner. Really here we are looking at the flow of money and where that money goes via a medical centre bank account or even a third-party bank account, then the third-party payment provisions could be applied. And that payment might be taken to be a payment for the provision of services between the practitioner and the medical centre. So as Stefanie mentioned, there's a number of exemptions that need to be considered in determining whether the wages are taxable wages for payroll tax purposes. And the key exemptions are the 90-day or less exemption. So that's where the doctor provides services for less than 90 days for a particular medical centre. And when we look at the number of days, any hours worked on a particular day counts as a day. So if a doctor was to provide 2 hours, 3 days a week, then that would count as 3 days towards the 90-day exemption within a financial year. And so if you are going to rely on the 90-day exemption, you do need to have records to substantiate that the practitioner worked less than 90 days for the medical practice. The next exemption is the 2 or more persons exemption that Stefanie did touch on and provide an example of. So it's important to note that if you are looking to apply this exemption from the medical centre or practice entity side, the second person working with the practitioner does need to provide medical services. They can't be providing admin services or be providing nursing support. What I've found practically in looking at the 2 or more persons exemption is the circumstances that I've come across that exemption could apply. It's generally been the case that the administrative or practice entity and that medical entity would have been grouped for payroll tax purposes because there has been a level of common control. So even though we've been able to apply that exemption, we've still had to potentially consider the payments and the amounts in both entities. So it may still be the case that there is a level of payroll tax paid on those amounts. It will depend on a number of circumstances, but I think in applying this exemption, we do need to be quite cautious of the grouping provisions and then what is happening in that doctor's entity in terms of how payments are going out to the practitioners. The other common exemption that could be applied is where the services are provided to the public generally. So in this instance, if the doctor provides services of the same type to another principal during the financial year, this exemption might apply. So if the doctor provides services to a specific practice for 10 days or less per month, then potentially you are able to apply this exemption. If the doctor provides services for more than 10 days in a particular month, you still may be able to apply the exemption, but you do need to go to the commissioner and seek the commissioner's discretion. So that would be an application to the commissioner for their discretion. When you're looking at the 10 days per month, you do need to exclude any months that the doctor doesn't provide services. And the other thing that we've noticed in relation to this exemption is, particularly in Queensland, where I do a lot of my work, there are a number of doctors that might be employed they might contract, for one medical practice and then be employed separately and do work with Queensland Health. And they're not providing those services under a similar relevant contract. They're actually providing the second provision of services under an employment arrangement. So generally, this exemption wouldn't apply to those types of arrangements. We are looking at arrangements where the doctor is contracting with a number of principals to provide services. I thought I'd just touch on the Queensland specific updates as these are obviously very relevant. So Queensland updated their ruling on the 19th of September. And as I said, what they did was updated the ruling to confirm that payments direct to the practitioner's bank account from Medicare or patient fees direct to the practitioner's bank account would not be subject to payroll tax. This revised ruling applies to all medical practitioners, not just to GPs, and it also applies retrospectively and prospectively for the reason that this is not a change in law. It is merely the Commissioner's view of how the law applies to the particular circumstances. So I'm not aware that there is any current planned ruling updates to be issued from the other jurisdictions. So unfortunately, despite our laws being harmonised, we do sit with a different position published view in Queensland at the moment, which I appreciate for national practices is a bit frustrating, but that's where we stand at this point in time. and I guess we'll have to see what the future holds in relation to that. So a couple of key takeaways that I just wanted to briefly mention is, firstly, similar, continuing on what Stephen has spoken about, the rulings actually confirm that where you do have a tenancy contract, provided certain conditions are satisfied, payroll tax should not apply on the basis that that tenancy contract would not be a relevant contract for the provision of services between the medical practitioner and the medical centre. But there's obviously a lot of requirements that need to be satisfied, both in the contract and practically. And I've outlined some of those on the slide. Secondly, the grouping of practitioners and administrative entities. That's really important, because we are seeing a number of circumstances where the grouping rules could still apply and they are being picked up just generally under reviews by the Revenue Office. Grouping has always been a focus by from the various, so it is important to consider the grouping rules and just make sure that you're correctly determining your Australia-wide wages and your registration requirements. And the last two comments I just wanted to make is the actual conduct's going to be really relevant here. So we can still have the agreement drafted in the best way possible to overcome payroll tax. We can have great references in it about the practitioner being a principal and there being a tenancy arrangement in place where all the practitioner is receiving is an exclusive right to use the particular room. But if the websites, if the payment flow, if the documentation and the practical circumstances don't reflect that, then the agreement's not going to be overly helpful. The last point we've just put on the slides, and this is for a reference, and I think we can delve more into deeper into this in the panel discussion shortly, is just, I think there'll be a number of questions about what happens if we get contact from one of the revenue officers. Do we need to make a voluntary disclosure? We're thinking about making a voluntary disclosure. What are the considerations? And we just wanted to outline the penalty provisions to everyone. So if you are making a voluntary disclosure, generally where that's unprompted, or if it's within 30 days of a prompt, the penalties should be reduced to nil. Equally, if you're making a voluntary disclosure after investigation, after an investigation has commenced, you will get a more limited penalty. And if you can show that you've taken reasonable care or the circumstances were beyond the taxpayer's control, that's another reason to have the penalties remitted to nil. But of course, if there are circumstances where payroll tax is going to be payable when it hasn't previously, having potentially an extra 25 to 75% penalty applied to that amount is obviously going to be really unpalatable. So there does need to be a good deal of thought and commercial reality in dealing with these matters if you do get an investigation. So I might just hand back to James now for the panel discussion.
Thank you very much, Leisa, and thank you also, Stephen and Stefanie, for those really interesting insights and practical tips. A couple of questions just sort of spring to mind and also have been raised as we've been chatting today. And maybe this one is best directed to you, Stefanie. So if a medical practice determines that it is liable for payroll tax, what are the other things they should be thinking about? Is there exposure to other employer obligations like super and workers' comp?
Thank you, James. And that's a really good question. And I think that there are other things that need to be considered. The first thing I will note, we are seeing a lot of sharing of information, data sharing between the revenue authorities and the other regulators. So it is something that if you're making a voluntary disclosure to ensure you're complying with your payroll tax obligations, that's not to say that the revenue authorities won't also be in contact with other regulators. Now, I will touch on how the other employer obligations operate. So if we look at superannuation, Superannuation is another big area that we're seeing a lot of activity by the ATO. And it is an area where there's a lot of scrutiny on contractors around super. And the reason for that, superannuation contains, or the legislation contains, an extended definition of an employee, and it includes someone who is engaged or working under a contract that is predominantly for their labour. And that's a really important note, or a really important thing to be aware of, because the way that operates is, if you are engaging with GPs or allied health professionals who are individual sole traders, it's possible that you may also have a superannuation obligation. So that's something to also look at, and to ensure you are aware of your obligations and whether you also need to contribute super. Because if you're bringing attention to, or given the attention that's being placed on payroll tax compliance, I expect that superannuation is something that's also being focused on in this sector as well. Then you've also got work cover. Now, work cover also contains contractor provisions. The provisions are very different across the various jurisdictions. So work cover is quite unlike the payroll tax regime, where you've got basically a set of relevant contract provisions that apply largely across Australia. From a work cover perspective, the legislation contains very unique arrangements, and it creates you really need to consider the jurisdictions in which you operate and be aware of how the contractor rules apply to ensure that you're complying with your work cover obligations. So again, when you're looking at your payroll tax, strongly recommend that you look at your super and also look at your work cover and be aware of what your obligations are in the applicable jurisdiction that you operate, and whether there's a need to voluntarily disclose.
Thanks, Steph. And it's interesting you raised the different approaches from the different regulators and also in different states. Might I ask, are you seeing an increase in audit risk specifically around GPs or healthcare professionals versus other industries in the various states where each of you are practicing?
I might start with that one, because that's a really good question. I think Victoria, given I operate in Victoria, and that's, Victoria has been very active in the auditing. The way they've typically approached their compliance activity is to be more targeted rather than random auditing. So we're typically seeing the SRO target their attention and their compliance activity based on areas that they see risk of non-compliance, and that might be sharing of information with the regulators. If it triggers an anomaly, will there be that could lead to an investigation. Now, in terms of the healthcare sector, so I actually had a off-the-record conversation with some contacts at the SRO just a matter of days ago, and the position at the moment, this is all off the record, is they're waiting for the dust to settle. At this stage, there's no mandate to specifically focus any audit activity on the healthcare sector. So I think it'll just be business as usual, continuing to data share, continuing to get information from the other regulators and focus their compliance activity based on any anomalies that are detected. Having said that, given that this is an area that is attracting a lot of attention, things can change very quickly and things can evolve. So I think it's just being aware of this and taking care that whilst there may not be a mandate to focus their attention on this sector at the moment, that's not to say there won't be in a few months' time.
And I guess in Queensland, we're not too dissimilar from Victoria in that we are seeing a level of audit activity, but these were taxpayers that were just generally identified as a result of the Queensland Revenue's audit activity rather than a specific medical focus. The feeling that I get in Queensland, although it's not been confirmed, is that there is that date to submit for the amnesty and do that expression of interest by the 10th of November 2023. So I would expect in 2024 we will see an increase in audit activity and an increase in investigations.
And I'm based in New South Wales, and the position here is certainly mirrored that in Victoria and Queensland that Stefanie and Leisa had mentioned, that there doesn't appear to be a targeted campaign, so to speak, focusing on the industry. It does seem to be quite random.
Excellent. And perhaps that waiting for the dust to settle sort of gives an opportunity for practices to consider, you know, restructuring if they find themselves on the wrong side of the ledger. Comments about risks on restructuring. I'm sure there's, you know, commercial as well as, you know, tax risks around that. Perhaps Leisa, what would you caution practices from doing?
Yeah, so I think what we need to be really mindful of, as Stephen mentioned, is if you do get an investigation now or a review, it will be on what's happened to date. So even if there is any kind of change or restructure, that will only apply on a go-forward basis when you have a new agreement signed. But I would caution that, given that there are anti-avoidance provisions in all of the payroll tax acts that talk about restructuring your arrangements merely to, or for the sole purpose of not paying payroll tax. So I do think that it is very risky now to be changing arrangements only to overcome payroll tax. That is going to be different to a practice that might be changing their arrangements or entering into new arrangements for other commercial reasons and looking at how they're going to expand their business. But I'd be very cautious about any restructure and seeking some professional advice before you do that.
I might just add a couple of comments. I think as well, the point that Stephen made at the beginning, I really like that. What has been done can't be undone. Just wanting to highlight the payroll tax legislation, the Tax Admin Act for each jurisdiction contains a 5-year review period. So there is an expectation that you can't change what's been done. So if you review your arrangements and determine that actually we do fall within the ambit of the payroll tax provisions and we do in fact have a payroll tax obligation, the expectation is that you're going to make a voluntary disclosure going back 5 years, which is the review period. In the absence of that, given what we've discussed around risk of audit, if that was detected, a shortfall detected, the revenue authorities would likely go back 5 years, and Leisa's already talked about what that means from a penalty perspective. In addition, there's interest as well. So I think it really does reinforce the need to review your historic compliance, because there is risk there if you have an obligation and you're just going to kind of sit and wait.
And I imagine, Stephen, there's also complexities around the commercial arrangements, sharing of information, privacy, all of those sorts of things that need to be considered if you're going to change the way that your business is being structured.
Absolutely, James, and that's a key conversation that I'm having with all medical centre clients when we're talking about these sorts of arrangements, is that payroll tax is obviously the topic of the moment and a very hot topic and a significant topic for the industry, but your service and facility agreements are contracts that deal with a lot more than just payroll tax. And so I think it's important to not get too blinkered by the payroll tax obligation. It's certainly critical to take into account, and there are prospective things that a practice can do, especially when starting out. But then we have to be very mindful of the anti-avoidance provisions that Leisa and Stefanie have referred to. But yes, you need to a good contract needs to be current, and there are lots of issues to be dealing with in a good service and facility agreements. So looking at a lot of older agreements I'm seeing don't even mention privacy. So obviously on a completely different subject, another very hot topic for, particularly given that we're dealing with sensitive personal information of clients, it's important to have a complete review of your arrangements. Just really briefly to touch on the anti-avoidance piece, and that is really critical. It's interesting in having conversations with a lot of practices. I'm finding that when you look at the contracts that they have in place, and quite often the arrangements that they have in place practically are actually better for them in terms of some of the payroll tax risks that we've spoken about, meaning quite often practice managers and practice owners are saying to me, oh, the doctors run the show, and we're not actually dictating the hours and the days that they work, and they're not actually applying for leave. And often these are things that are covered in the contracts, but practically speaking, a lot of these risk factors are actually practically addressed, and so there are arguments in there that we are, in amending arrangements, we are really just doing new contracts to reflect the actual commercial arrangements that are already in place. But again, it's very important to get specific advice on a case-by-case basis with these things, and particularly when we are going into the substantive issues of the money flow, which is sort of the #1 obligation, then that's going to be a much higher risk area where you'd need to get particular advice.
Thank you. And look, we're coming up to time, so look, I'd really like to just bring this to a close now, and I want to thank Stephen, Stefanie, and Leisa for their insights, both in terms of technically what the requirements are, and also practically what we're seeing from the collective discussions we're having with both clients and the revenue authorities, because I think that gives a really good insight and a really good reminder that now is the time to act. This issue is not going to go away. These cases have been decided. Revenue authorities are putting out rulings. Amnesties are in place. So medical practices really need to sit down and think, is there an historic issue? Should I address it under an amnesty? Should I make changes in a way that is both commercially sensible, as well as making sure that they're not going to trigger any anti-avoidance issues with the payroll tax rules. So thank you very much for your participation today. And for those on the line, thank you very much for your attendance. We much appreciate your participating and taking the time out of your busy days to join us. As I mentioned up front, following this session, we will be sending out an email that will have a link to the recording as well as to the slides. And look, if there are further questions that have arisen, we certainly welcome those. A little bit of a plug for the next 6 months or so with our Working in Australia webinar series. We have some sessions coming up around payroll compliance, the fun of FBT as we roll into the FBT season in sort of March next year, and then some year-end obligations, which is still well over 6 months away. So we'll be covering those in the sessions going forward. But thank you once again for joining us today, and enjoy the rest of your Wednesday. Thank you.